People often criticize Warren Buffett for not liking modern digital things like Bitcoin or NFTs. He thinks Bitcoin has no value because it doesn't produce anything. He wouldn't want to own all the Bitcoin in the world, even if it was offered for $25, despite its price reaching up to $70,000 per coin and its total value going over $1 trillion. Buffett sees this as silly. This isn't the first time he's been skeptical about new technology. Remember the dot-com bubble? He felt the same way about online businesses. His friend Bill Gates tried many times to get him to invest in tech companies like Microsoft, but Buffett always said no. He's missed out on big chances with companies like Amazon, Netflix, and Tesla. For example, if you had put $1,000 into Tesla when it first started, it would be worth around $225,000 now. A $5,000 investment could have turned into $1 million. If he had put a few $1 million into these companies, he could have made hundreds of millions by now. Despite all these missed chances, he still holds his views. Warren Buffett's wealth sometimes exceeds $130 billion, even when the economy is struggling and the stock market is dropping. During the 2008 recession, he was even named the wealthiest person, surpassing Bill Gates. However, besides avoiding digital assets like Bitcoin and NFTs, Buffett also steers clear of the housing market. Surprisingly, he doesn't invest in real estate. The only property he's ever bought is his home in Omaha, Nebraska, which he purchased in 1958 for $31,500, around $285,000 in today's money, and where he still lives. So why does the world's most successful investor stay away from real estate, especially when many consider it a very safe investment? What does Warren Buffett know that we might not? While these questions are intriguing, it's crucial to acknowledge that Buffett's investment strategy, regardless of criticism, has proven incredibly successful. He's outperformed the S&P 500 by 84% over the past 2 decades, securing his position as one of the greatest investors ever. He's been investing in the stock market for a very long time and has consistently made profitable investments. When Warren Buffett was asked about buying a house, he gave a clear and simple answer. Go for it if you plan to stay in one place for a long time. He even praised the 30-year mortgage as an excellent financial tool. So why does he avoid investing in real estate, especially during moments like the housing market crash when he had plenty of cash? Investing in real estate is very different from investing in the stock market. Real estate requires hands-on management. Managing one property might be manageable as a side project, but if you have multiple properties, it becomes a full-time job. Owning property doesn't guarantee you can rent it out all the time, yet you still have to pay the mortgage. Properties need maintenance, and in tough times you might struggle to find tenants. This doesn't mean real estate is a bad investment, it's just a different kind of business that demands a lot of time and attention. Warren Buffett chooses not to invest in real estate because he values his time and prefers to focus on finding great investment opportunities elsewhere. Warren Buffett has indeed invested in real estate during his career, primarily through real estate investment trusts, REITs, such as his notable investment in Store Capital Corp. REITs are funds that own and often operate income-producing real estate. Investing in REITs is similar to buying stocks, providing a way to invest in real estate without dealing with the complexities of owning property directly. Buffett's hesitation to dive deeply into direct real estate investment also stems from the challenge of finding great deals. A key investment strategy is to find undervalued businesses, those priced lower than their actual value due to various reasons like scalable business model or innovative technology that could yield significant profits. The stock market frequently presents such opportunities, especially during the crisis when panic can lead to significant undervaluation. For example, if a major company's stock price drops significantly without a corresponding decrease in fundamental value, that presents a buying opportunity. In contrast, real estate prices don't fluctuate as rapidly and great deals are rarer and harder to find. Real estate markets don't crash as often as stock markets, and when a good deal does appear, local real estate professionals might snap it up before the general public becomes aware. This dynamic makes it easier for Buffett to find undervalued investment opportunities in the stock market compared to the real estate market, aligning better with his investment philosophy and approach to capital allocation. Unlike the stock market, where investors can easily browse and trade a wide array of stocks from their offices, there isn't a similar centralized exchange for real estate. Companies listed on the stock market undergo rigorous approval processes and must regularly disclose their financials, providing transparency and opportunities for informed investment decisions. Real estate primarily offers tangible value, like providing shelter, which doesn't inherently increase in financial terms as a business might through scaling and growth. For instance, there's a limit to how much someone would pay for a night's accommodation, but a business like Apple can expand its operations and market value extensively. Buffett's investment in Apple, which grew from $36 billion to $160 billion, illustrates the scalability of stock investments compared to real estate. Additionally, Buffett's investment in See's Candies showcases the potential for extraordinary returns in the business world, something that is challenging to replicate with real estate investments. The scale of the market also plays a role. The US real estate market is significant, but it's dwarfed by the stock market, which is about twice its size. This larger pool of capital in the stock market translates to potentially greater investment opportunities and returns. The absence of real estate investors among the world's top 10 wealthiest individuals underscores this point. The wealthiest real estate investor is significantly less wealthy than the top investors in the business and stock markets, highlighting the different scales of opportunity and wealth generation in these sectors. Donald Bren is the wealthiest real estate developer in the United States, with a net worth of around $18 billion. Despite the many opportunities in the stock market, Warren Buffett focuses on leveraging his expertise and time most effectively. If he can amass over $100 billion through stock investments, why should he shift his focus to real estate? Buffett's monumental success stems from his steadfast adherence to his investment strategies and principles. He doesn't chase after the latest trends or diversify into different assets just because they're popular at the moment. This disciplined approach is a key takeaway from his investment philosophy. Buying a home can be a wise choice if you're planning to settle in one location for an extended period. However, venturing into real estate as a business is an entirely different proposition. It requires a commitment and a readiness to engage in a new business venture. The crucial question is whether you're prepared to take on such an endeavor, considering the differences in dynamics and potential returns compared to the stock market investments. What do you think? Let us know in the comments, and if there's anything you're curious about, tell us. Make sure to subscribe to keep up with our latest videos. We'll be back for more interesting content soon.